All right. I'm gonna try it. Andre, I'm gonna try and cut this short. Yeah, I got one too, just in case. Oh, there's one there. Oh, you get it less time. All right, cool. I'm gonna get it. Good. That's fine. I didn't know that much less. Sorry. Well, all right, guys. Anyways, first of all, thanks for having me. Lots of stuff that I really enjoyed, even having been in this world for a long time. I'm always learning some new stuff, so thanks for the presentation. I'm gonna get into the really boring stuff, which is mortgage financing. Unlike real estate, brokers who have really sexy content they can put out, show you the tour of the house and all the renovations. This is just numbers, guys. So for some of you guys, at least this is what I'm told sometimes, this is what my world looks like. Sometimes for us, also looks like this when you guys send us some of your applications. We're like, what the heck is going on here? But what I'm hoping to achieve with this presentation is to give you broad strokes. I know there's different individuals here, some pros, some that are getting started, and everyone else. So I'm hoping that you guys can take some value from the presentation and learn more or less what the landscape looks like. So as a mortgage broker, we do work with everyone out there. So this presentation is going to be very sort of broad versus just focusing on what one bank will do. Hopefully we've got some insights. So I'll talk about the lending environment in Canada, and hopefully there's some stuff in there that a lot of you guys don't know or didn't know that could open up your eyes and realize, hey, you know what? Maybe I can get into investing a lot sooner. We're going to get into the blueprint approach. So buying a home that is going to be a rental property is very different than buying a home that you're going to live in. The options and the way you should approach it is going to be very different. We'll talk about some of the new releases that have just come out, and then we'll end with the rates because that's what everyone always asks me about. So right off the bat, this is just a really quick sort of managing expectations. This is where the banks want you to be at in general. You know, this is sort of just conservative numbers. So if you want to be at $1 million mortgage, I need to prove to the bank that your portfolio's got $180,000 on average, more or less. That should kind of give you an idea what sort of numbers we're dealing with. So when a client comes to me and says, I am retired, I am unemployed, that doesn't mean you can't get a mortgage, it just means the type of mortgage we're going to get is going to be very different. This is just kind of a more or less a general guide just for your info. So let's get into the lending environment. So there is a distinction to be made between residential and commercial, specifically how many units. So in Canada, for the most part, a residential home is anything that's got 4 units or less. There is a little bit of an exception. We have one lender that'll go all the way to 8 units and treat it as a residential. For the most part, 99% of the lenders, if you've got 4 units or less, you fall into the residential bucket. It doesn't matter if you're buying it in a company or not, it's still a residential bucket. And then we've got the commercial stuff, which is usually 5 units or more. When I say commercial, because commercial can be like a gas station, I'm talking about multi-unit type commercial. So 5 units or more, for the most part, you're getting into commercial lending, and it can be CMHC. I don't get into commercial on this presentation, but we can chat about that offline if that is interesting to you. There are also different ways we look at clients. So if it's a residential mortgage, we look at you guys and your profile. You know, what's going on with these guys? Does it make sense? Do these guys and their rental properties and everything else make sense for this deal? With commercial, a little different. I'm not saying you should be unemployed, but you could technically be unemployed. As long as the property has good financials, there's a home for that. So a little bit different. And sometimes we navigate the different options depending on where your life cycle is at. If you've grown a portfolio and you've got a bunch of properties under your belts and you're finding it difficult to get financing, sometimes it makes sense to go into commercial, which could be a little easier, works to your benefit. So this is the general pool of lending in Canada. That doesn't include money laundering. That's not on this deck. That's a different one. I do that later. But these are the types of lenders that exist, and depending on your life cycle, we're going to be in and out of the various lenders on the screen here. So are they lenders? I'm not going to spend too much time on this because I've already lost 5 minutes. You guys understand what a big bank is. You guys deal with these guys. You understand why you would want to go to a big bank. They do a really, really, really good job telling you that they're the best option for you guys because they have tons of dollars for advertising. They're not necessarily always the best option, but there's certainly an option that we like to explore and we get into. Monoline lenders. So this is all, just to be clear, under the A lending bucket. So just because it says monoline, it doesn't say bank, doesn't mean it's a bad option. I kind of describe it like car insurance. So for a lot of you guys who have cars, hopefully you have car insurance, you may not have car insurance with the big banks. It might not be RBC or TD or whatever. You might have this random company you've never heard of, but it's a great product and it works. Kind of like that with monoline lenders, where they're not physical buildings where you can open an account. They're just what we call sometimes non-bank lenders. And these types of lenders normally get their funds from institutional investors like pension funds. So it's like, here's $400 million, lender. You have to lend money out using this box. Don't get outside this box. And in exchange, the rates are sometimes very competitive. So that's, this type of lender. So First National, unpacks. These are just some examples. Some of them might look familiar for some of you guys. So again, these are not B lenders. For the most part, they're still AAA type stuff. Credit unions, also, I think the last one on the A lending bucket. These guys here are going to be great when they're more niche type lenders. So in certain neighborhoods, you're not going to see too many banks. Some of these guys exist to service that community. So where we find financing where maybe it's a lakefront property, maybe it's an island, nobody wants to touch that. The credit union, because they're pooling resources from their members, do some really cool stuff and often have very competitive rates. We love Desjardins. It's a huge, lender out in Quebec. But they're really, really investor friendly. So one of the lenders we like to work with. Now we're just gonna move into, of the spectrum of rates, you're kind of moving into B lending. So now the rates are getting a little more expensive. But in exchange for the rates getting more expensive, these guys are going to be awesome if you're self-employed, if your ability to prove income is a little bit limited. These guys are going to do a lot more common sense lending, which is I know you report $20,000 to CRA, but your business makes $1 million. Let's figure out where we can figure out a solution for you. So these guys will be slightly more expensive, but again, a lot of individuals, especially if you're self-employed or if you're buying a home that needs some work, you're going to start here and then at some point move into a bank if possible. Then we got private lenders. With investors, private lending is often used for things like flips or scenarios where you want to leverage equity in a portfolio to help get in and out of something. I don't like to do privates unless we have a really clear exit. I'm not in this business to say, hey, Ming, I'm going to give you this 10% loan forever. Thank you so much. I want to get Ming out of that as soon as possible. And if we don't have a clear strategy, I'm not comfortable recommending that, because you need to have an exit strategy, because an 8, 9, 10+% interest rate indefinitely is just not sustainable, at least in Canada anyways. And the last one is reverse. So this one's relatively new. Now, again, this is a whole presentation on that one. It's a very popular option as our demographic gets older, as we see tons of equity in homes, and there's a lot of properties out there that have no mortgages. A lot of parents are gifting funds to their kids to help buy real estate. And often it's my mom and dad are giving me $500,000, which is awesome, because that wasn't an option for me. And they are using that to help purchase real estate or investment properties. Very often these folks are using HELOCs, which are a little bit more expensive. A reverse mortgage is more like, here's some money, you don't ever have to pay me back until you die. And in the meantime, it's going to compound. So it's not for everyone, but there's some really cool ways you can use a reverse mortgage as an investor, but even just for financial planning. If you're a senior, this is the evolution of where you're at. So let's kind of jump into what we call our financing blueprint, which is really just trying to be strategic with how you get financing. So this is probably a great visual. I just gotta edit that. Looks a little off, but ignore that, guys. So the idea is like a chess game. You're always forecasting and predicting your sort of next moves. That's how I like to approach financing, specifically for investors. The idea is it's not necessarily always about rates. I mean, the rate is important, but all that really matters is what cost of interest you actually pay. So for some of you that are like, I've got a 1.5% fixed rate, good for you, you have that. But if you decided that I want to now break my mortgage or I want to make changes, you are going to incur some sort of penalty. Sometimes that penalty offsets the amazing rate that you have. So you have to look at this strategically. You have to understand which lenders are important in the beginning of your growth and which ones we should use later. This is where working with a broker can give you that sort of 100-foot thought on, here's the lenders we should go here, and then this is where we're going to go next, and so on, so that you can kind of work backwards and have a proper strategy. That's kind of how we're looking at these files versus just, this is the best rate, let's go there. That might not be the best option. That's kind of what I wanted to get across with this. So a couple programs that I wanted to cover that exist, that don't fall in that bucket. And hopefully for some of you, you're like, I didn't know that. So the first one is, we call it NIATs. That's just kind of an internal thing. I don't even know if anyone else calls it that. That's what I call it because it's just easier to say. But it stands for net income after tax. So if you're self-employed, if you have a business, specifically a corporation, your business makes money, hopefully, and there's profits in that business. Normally you pay yourself a salary or a dividend if you want, and there might be profits remaining in that. The banks look at that, and this is really the net income after tax. This is like a profit. The banks, in some cases, have programs where if you don't pay yourself a lot of money as a business owner, because as a business owner, we like to pay less taxes, we like to, try to keep as much revenue in the business, and we like to be as efficient as possible, because these are all options available to us as Canadian business owners. So very often, self-employed individuals will keep money in their business. There are programs where we can look at your salary and the income in your business to enhance your income and still get a deal done with a traditional A lender. So this is something interesting. And with us going into tax season, it's a really, really, really important opportunity for any of you guys who have real estate and mortgages to have a chat with a mortgage professional about what you need to do come tax season to make sure you're not shooting yourself in the foot. Because for self-employed individuals, the banks are looking at a 2-year history, right? So whatever you reported last 2 years is what we're using now. So you want to be mindful as we get into tax season. Net worth programs are basically if you've got cash that we can verify. So, physical assets and Bitcoin are currently not available as options. But if you've got RSPs, TFSAs, whatever, and your income is sort of reduced, there are some programs where we can lean on that and still give you access to lending, so keeping you with some attractive options. Equity programs, for the most part, the banks don't care that your place has a bunch of equity. They want to know you can pay payments. So I get this all the time where it's like, my place is worth $2 million. I have no mortgage. Why is the bank not giving me a mortgage? Because you're unemployed. How are you going to make payments? I need to prove this to the bank. Now, there are some programs where if you have a certain amount of equity, there are some options where you can get line of credits and mortgages specifically on your personal residence. So these are sometimes programs we get into. And the last one is just expanded ratios. All that really means is the banks, when they're doing a mortgage application, are trying to understand your expenses and income. So it's great that your credit score is amazing. At the end of the day, it's cash flow, it's income, and it's expenses, that ratio. Typically, the banks cut you off at around 40 to 44% of your income. So if you make $100,000, you don't want to be north of $40,000 to $44,000 of expenses. That's where the banks are saying you're high risk. Now, there are some lenders where if you meet certain requirements, we'll go a little bit beyond that and can get you access to lending. So again, this is just a little bit of a sample of the stuff that is out there. Okay, I'm gonna crush this. 1 minute. This is a B lender example. So again, B lending is slightly more expensive than A lending. So let's say I need $1 million. I already told you guys that roughly $1 million mortgage in Canada needs about $188,000. Is there a laser on this? No. Okay, $180,000 income to get $1 million mortgage with an A lender. If we were to go with an A lender, on average, your monthly payment's about $5,000. But in order for you to report an income of $180,000, and there's an accountant, don't like crucify me here. This is off like an online calculator. You need about $55,000 in Ontario to report that kind of income. So that's the income tax. That's what the third line is there. Your cost of interest, this just means how much interest you pay on the mortgage for 1 year, is about $44,000. And to go to an A lender, generally there's no fees. Maybe an appraisal, but generally there's no fees. So over a 1 year, you go with an A lender, your cost in terms of income tax and interest is, let's just call it $100,000. That's your A lender option, your super sexy low rate clients. But you're self-employed clients, and you have the option of not reporting 180. Let's say you just reported 30, because you could do that as a self-employed individual. So you reporting $30,000 means that your tax bill is only $6,700. The 160 that I use there, I put out a little thing there, stated, that just means that I can prove that your business made 160K, at least. You didn't report 160, I can just, through bank statements, prove that you did, right? Your monthly payment is higher, that's about $600 higher, so cash flow is affected, right? And then the interest cost is higher because the rate's marginally higher too, so the interest is $54,000. And generally a B lender is gonna charge you a fee, it's 1%, that's the average, so $10,000 is your fee. You add up your cost of the fee, you add up the cost of interest, over 12 months you actually paid $70,000 total. So even though the rate might be 1% higher on the right side, you still save $29,000. So this is the kind of logic that sometimes you have to kind of look at when you're making these decisions. And sometimes trying to go to an A lender doesn't make sense, despite the rate being low. So that's kind of what that is all about. So 10 minutes, cool. New mortgage initiatives. You guys have probably heard a lot of changes. I would say, going back to one of the slides that I think Ming did, some of the stuff in the news is political. I don't really think there's any value in these things, but I'll tell you they are out there. This one's actually kind of nice. This is an insured program. For the last, I don't even know how long, for quite a while, we've been maxing out how long you can stretch a mortgage to 25 years when you put down less than 20%. That's called an insured mortgage. At the moment, they've allowed us at the end of last year to stretch that to 30 years, which just makes sense. I have no idea why a first-time home buyer has the hardest rules to get a mortgage, and they were limited to 25 years, where if you're like 55, it's like, you don't even need to pay us, it's all good. Just pay us when you're dead. Like, it's wild how the rules don't make any sense for first-time buyers. So this is a cool initiative, I like this, makes sense. I think it's pretty self-explanatory. The other one that has kicked in, which is also pretty nice, but it's like niche, is the minimum down payment required has been expanded from $1 million purchase to $1.5 million. That just means that previously you were limited to roughly $75,000 down payment on $1 million home purchase. That number has gone up to 1.5 million, meaning you can put less than 20 down, up to 1.5 million, which is 125K. To qualify for a mortgage for 1.5 million, you need north of 200 grand. So there you go. That's why that program sounds cool. I don't know. I'm sure I'll eventually do one of those, but it's not common that a first-time buyer is cranking out almost $300,000, to buy their first home. But it's a good initiative for sure. I don't think it's a bad one. This one could be interesting for some, maybe not so much this group, but I'll share it anyways. So as of November, the banks had said, hey, we're going to make it easier for you to move your mortgage at maturity. You don't need to qualify for the stress test. So whatever the rate is, that's the one we're going to use to move your mortgage over so that you can have more options. The reason I think that doesn't apply in this room is very often investors are always refinancing and taking money out. As soon as you say, wait, I don't want to move my $500,000 mortgage over, I want to take some money out and do all this cool stuff. Cool, this doesn't apply anymore. So as an investor, if your intention at maturity is to take money out, maybe optimize cash flow by going back to 30 years, these are all things that we talk about all the time. This doesn't really matter, but if you do want to move your mortgage, it has become a little easier, so also not a bad initiative, I guess. This one's a joke, but okay. We have 100 agents in the country, and we all laughed when this came out. We're like, who's qualified for this? But anyways, it sounds nice on paper. This is why sometimes these announcements are political, in my opinion. So January 15, you are now allowed to refinance a home that was already insured, meaning you put less than 20 down. Up to $2 million, you can borrow 90% of that. That's an awesome, that's amazing. When I first saw that, I'm like, that's cool. And so it means that you as long as you're adding one rental unit and you're currently living there, so again, super niche, you have to live there, you have to already put had put less than 20% down because it was insured, and now you've decided you want to add a rental unit. So all good stuff. The problem is, again, how are you going to qualify for a $1.8 million plus mortgage? Your income needs to be, now we're almost at 400 grand. So it sounds great, but qualifying is still very restrictive because it's an insured mortgage. So again, it's going to be ultra niche, but the general idea and the direction that some of these decisions are, I think is not a bad one. There's also a home renovation loan that you can use in conjunction. Again, this is a separate one. You can borrow up to $80,000 at a low rate. You pay it over 15 years. The idea is to use this loan to add a rental suite. I think it's a good policy. And you could also use it with that other one I just mentioned as well. So combined, there's some really cool programs, but it does come down to qualifying because these programs are A lender type rules. So I can't get into the B or the private. I can't do all that cool stuff I showed you. It's very specific on how you can get in and out of these things. Again, some of the requirements are you need to live there and you can only go up to 4 units. So I've got 6 minutes, I think we're good. Is there a question? Okay, sorry, there's a question. Yeah, so the stress test has not changed, it's 2%, but rates are 2% lower now, sort of, from their actually, there you go, perfect segue, we planned that. So rates have actually dropped 2% from in the last, 6 months or so. So the fall of last year, we saw rates go down. If you look at Rates. How many of you guys have 1 point something mortgages still? Anybody? Someone must have it. No? Did you put your hand up? You're stretching. Okay.
1.9.
But I see them a lot. Like 1.4, like 5-year fixed. These people are thinking they're legends. They're like, I knew it was gonna be, we're gonna go into COVID like I did this. It's awesome if you do, but yeah, that's kind of where we were here. COVID happened, which is wild because it's like, I forget the world before COVID, but COVID happened, rates, this was COVID. After COVID, we saw rates fly up to 5%. And to be specific, this is a graph representing the Bank of Canada benchmark rate. These are not your rates. This is what the Bank of Canada is basically selling to the banks. You have to add another 1 or 2% premium on top of whatever that is, right? So this is just to show you kind of where rates that particularly affect variable mortgages or HELOCs have been. And they were as high as 5% benchmark, which was about 7% mortgage rate. Did anyone have a 7% rate or has a 7% rate? You can put your hand up. There's a lot of people that I've seen. Okay, cool, yeah. That was the reality like 2 years ago. Fortunately, if you're on a variable rate, you guys have seen the massive drops. You've seen 2% worth of rate drops, which I think is awesome, and I think there's more to come, which I'll show you guys as well. Let's pivot to fixed rates. So this graph was on February 4th, my date there. It's about 10 points higher, I think, as of like today. So it's 2.7, I think. So if you want to know the direction of fixed rates, you can always pull up something like this. You just 5-year government bond. This tells you the movement of the bonds. Now, separate from variable, despite what clients tell me, the Bank of Canada telling the country that rates have gone down doesn't necessarily mean that your fixed rate will go down. So just because the Bank of Canada dropped 0.5% not too long ago, doesn't mean that your rate's 0.5% lower if it's fixed. If it's variable, yes, it would be automatically dropped for the most part. Fixed is just a completely different market. Fixed is going to look at different metrics to determine whether these rates need to go up and down. So if you look at this little thing right there, we actually saw a huge fall off of bond yields around this whole tariff conversation. So when tariffs were announced, when Trump went in power, and all these things in the last week have happened, we saw rates actually come down quite a bit. And I think the general assumption is if there are tariffs, things could be more expensive for us. Equities, which is like the stock market, doesn't look as attractive. Let's move money into bond yields. This is, for the most part, a very simplistic explanation as to why rates have gone down on the bond side, and why if you have a fixed rate, and I'm not suggesting fixed rates are the best here, but if you have a fixed rate, if you're looking at getting to a fixed rate, because that's the best option for you, I would say maybe wait till the end of February, possibly March. If these rates stay low enough, I wouldn't be surprised if rates start getting under 4% for like 3 and 5 year terms. It has to be sustained, because just because the rates have come down doesn't mean that the banks want to pass that to you. They take their time, nice and slow, make sure that we are in fact in this environment before they do that. But as soon as rates go up, you can almost 1,000% guarantee that rates will go up on the mortgage side, because that's how banking works. So that's a bit of an idea as to what's happening there. So what we've done here is we've taken forecasts. I think this was pre-tariffs. So I don't think most of this has changed, but generally it should all still be similar. So we've kind of just looked at economic forecasts on what the banks believe the benchmark rate will be. Again, this is the variable rate indicator. And on average, by the end of this year, which is that one, rates are, so Scotia's is like rates are not going down anymore. I guess that's their decision, fine. But the average economist believes that rates can drop as low as 1%. Again, this is pre-tariffs. I don't necessarily think that's all factored in here, but for the most part, still seems to be the same. So as low as 1% more rate drops to on average, like maybe 0.5%. So if you guys are trying to figure out, should I lock in now? Should I wait? I think there's still some room to enjoy variable rate. Let's kind of see what evolves over the next couple months. I don't necessarily believe we're going to be in an environment where rates go back to 7% at any time soon. I think there's an opportunity to see more discounts, so I would wait it out. I'd kind of ride that wave out a little bit just based on what we know today. We got a minute? Okay, cool. Fixed or variable? Again, this is a pretty big conversation or a very common question. Again, this is just my personal opinion, and I'm using it as a generic sort of comment because everyone's a little bit different and everyone's circumstances are different. I would say generally a variable rate is what I would be suggesting right now for a few reasons. The biggest reason is we just saw that there's more potential for rate drop. So going in with a variable rate is going to allow you to enjoy some additional rate savings. At this current moment, the best 3-year fixed rate and the best 5-year variable rate, which is kind of the two that we're usually recommending, they're very similar. I would say the fixed rate is marginally lower right now, from anywhere to 0.1 to maybe 0.25% lower than a fixed rate, or than a variable rate, sorry. So if you believe that rates are not going down, then go with a fixed rate. That's what you believe. If you believe there's any possibility that we'll have at least one more rate cut, you should go with a variable rate, because you get to enjoy that discount versus locking in for multiple years. And I have way too many clients that last year locked in at, I think it was mid-5s at that point, that are now seeing rates in the low 4s. Even just before coming up here, I got a text saying, I'm at 5.89, I should listen to you, what can we do? The problem is his penalty is probably 50 grand, I just checked. So those are tough conversations, and why I say flexibility is very important. And that's another feature of a variable. Is you can go from a variable to a fixed, there's no penalty. You want to get out of a variable because you want to sell the property, you want to renovate or refinance or whatever, because you're investors, it's a 3-month interest penalty. It's a very easy way to calculate that. So that's my takeaway. Little final thoughts. You know, look, financing is a huge component of real estate investing. It's really important to know your options. And I would say more than ever, be prepared, have a conversation with someone who understands that stuff. And my team and I, so Tyler and Kyle who work with me, and a lot of you guys have worked with all of us, they're in the back there. If you scan, I gotta get rid of this photo. If you scan the QR code, it'll take you to a Google Forms where we're gonna collect your data and sell it for the most part. But, it'll set you up so we can do like a private consultation, because so taking advantage of that. We're also here the rest of the event, and we can have chats if you guys want to in one of the areas of the university here. So anyway, thanks guys. I think I'm good for time, hopefully.